So chapters 20 and 21 cover partnerships, and I'm not exactly sure why the authors of the book thought they needed 2 chapters to cover partnerships, but apparently they felt like it was really, really important. So they used 2 full chapters, which increases your reading load, but I'm going to lump them all together into a single lecture, and I'll try to make it pretty quick. Before I even get into partnerships, just generally speaking, the next 4 chapters, these 2, 20 and 21 on partnerships, and then 22 and 23, they all cover something that we call business structure, or how the owners of the business own the business and that entire process. So the next, like I said, the next 4 chapters, next couple weeks, we'll be going over the different forms of business and sort of the legal ramifications of each. So partnerships are important because a lot of small businesses are partnerships. The reason that a lot of small businesses are partnerships is because you can become a partnership without any effort on your part. If 2 or more people start a business together and they don't take any other action, they don't file with the state or file for some other sort of business structure, then they're by default a partnership. So it's important because a lot of you will be part of partnerships at some point in your life. It's also important because it's super easy to become a partner without even meaning to. And what I mean by that is a lot of times 2 people will just, 2 friends like doing something together and they realize they can make some money by doing it. And so they just start making money and they don't realize that they're a partnership. And so all of the legal ramifications of being a partnership fall on them without them even realizing or intending to do that. And then the third thing I think is important about a partnership is that maybe this is why you might want to have a partnership, is because a lot of times different people have different levels of expertise. My wife is an artist. She paints giant paintings on the sides of buildings and things like that. I don't have that expertise at all. I can't do that. But I'm pretty good with books and numbers. And so together, we're actually able to form a more stable business than either one of us would be able to separately. So I think that's maybe the most important reason to have a partnership, is because when you have more people involved, you can leverage the skills and knowledge sets of all of the people. So a brief kind of history, super brief history of partnership, because I think it's all you really need, is to know that the first Uniform Partnership Act, so the first attempt to sort of make partnership laws the same all across the US, happened in 1914. Before that, there was partnerships. I mean, it's always been there, but this was just an attempt to sort of make the rules consistent across the board. And then in 1997, what's called the RUPA, you'll see it abbreviated in your textbook over and over as RUPA, or the Revised Uniform Partnership Act, was passed. And most states, as of today, have fully adopted the RUPA, meaning that most states have the same laws as they relate to partnerships. Business structure and formation is not really a federal thing. It's kind of recognized individually by each state. But because of things like the Uniform Partnership Act, it's pretty much the same in every state because they've all adopted the same model legislation. So a partnership is an entity, meaning it's recognized by the law as a person, and I mean that in the business sense, not necessarily as a real person, but in a business sense, for all of those purposes you see on the screen, accounting. So when you deal with the IRS, the partnership is like its own person. Litigation means lawsuits, bankruptcy, and then owning of real estate and other real property. And then finally, partnerships don't pay taxes. So even though they're recognized as a separate entity from the owners, they're what's called a pass-through entity, meaning any profits earned by the business are passed through to the owners, and then the owners individually pay taxes. The partners individually pay taxes on the partnership profits. So how do you know you have a partnership? Well, the first thing is if you have two people or more carrying on a business for profit. So those are the tests, so to speak, of partnership. Two or more people in business for profit. You can see the second bullet point says the primary test of whether a partnership exists is whether there is a sharing of profits. So if you go to court and someone says, I'm suing this partnership, and you try to say, oh, I'm not a partner, we're just a couple buddies doing business together, the thing they're going to look at as a test is, are there two or more of you? Yep. Are you in business? Well, if you sold something to somebody, then yep. And then are you sharing profits? Well, is it for profit? Yes. And then are you sharing the profits? And if you're doing all those things, you're going to be called a partnership by the courts, and then you're going to be liable just like your buddy is for whatever you sold to the people. Most partnerships are expressly created. That means the partners intended to be a partnership and usually drew up a document called a partnership agreement. And a partnership agreement is an important document because it spells out all of the factors or all of the issues relating to the business, including the name, how much each partner is going to put into the business financially. That's the capital contribution. Profit sharing, how much of the profits each partner is going to get, and decision making, who gets to make what decisions. That's all spelled out in a partnership agreement. I would recommend to you, if you ever decide you want to start a partnership, that you draw up a partnership agreement. It doesn't have to be written in fancy legal language. It just needs to spell out some important things, like some of those ones I just mentioned, so that there's no disagreements later. It might even be worth going to a professional and paying a fee to an attorney or a CPA to help you draw that up, so that it's legitimate and everybody's protected. But if a partnership is not expressly created, it can also be created by what's called implication or by estoppel. That's the legal term. And in essence, that means if somebody has represented or held themselves as a partner to another and that other person relied on that representation, then a partnership could be created there legally. That's kind of back to the idea that sometimes people are part of partnerships even when they didn't intend to be. So partners have duties to the partnership. The first is what's called a duty to serve. That means that the partner will will work on behalf of the partnership. A duty of loyalty, meaning the partner won't say use the partnership to enrich him or herself, but allow the partnership while the partnership suffers. So you're loyal to the partnership, meaning your work is going to work toward helping or strengthening the partnership, not against it. You have a duty of care, which means to be careful or to care about the needs of the partnership. And again, to not do anything that would be injurious to the partnership. A duty of obedience, meaning if the majority of partners agrees to a certain course of action, then even if you don't like it, you need to move forward with it. It's a little bit tough when you only have two partners, right? Because then you have to figure out which direction you're going to move, even if you disagree. A duty to inform co-partners, which means let co-partners know if you've done anything material that impacts the partnership. So if you borrowed money in the name of the partnership, then you have a duty to inform the others. If you transacted business in the partnership's name, then you have a duty to inform. And finally, a duty to account to the partnership, which is similar to the duty to inform, which just means you have to make a fair accounting of the business that you've done. You can't like hide profits or losses or things like that. You have to account to the partnership. So the partners, in addition to their duties, they have rights. Rights include a distribution of the money, meaning if the business makes profits or has losses, those pass through to the partners. Indemnification, and return of capital contribution. That just means that a partner has the right, in essence, to sell out of the partnership and at least get what they paid in so long as that money is there. If the partnership doesn't have that money, it doesn't necessarily happen. A right to management in accordance to what's written up in the partnership agreement. A right to choose co-partners, meaning the other partners can't decide to add a new partner without the approval of the other existing partners. Property of the partnership, that means that what belongs to the partnership belongs to all the partners. Not necessarily individually, though. Okay, that means that a proportion of that belongs to the partners. They have the right to assign partnership interest, meaning they could borrow money against partnership assets. But again, when they do that, they have to be doing so for the good of the partnership, not just for the good of themselves. And finally, they have the right to enforce all of these duties by suits in law or equity. What that means is the partners have a right to expect all of these other duties to be performed by the other partners, and if they're not, then they can enforce those duties by law. In other words, they can sue the other partners if they don't hold up their end of the partnership. So this is an important and scary part of being in a partnership. The partnership is generally liable for any contract made by a partner. And all partners are liable for those contracts or torts committed by any partner if that partner is acting in their normal role as a partner. So if any of your buddies that you start the partnership with commits a tort, which we've learned about already, then all the partners are liable. The liability is personal, okay? Being part of a partnership doesn't protect your private assets, meaning if someone sues the partnership, then all the partners are personally liable, even to their own personal assets, not just the partnership assets. And it's unlimited and joint and several, meaning everybody in the partnership. Incoming partners aren't liable for anything that occurred before they were a partner in the business. So if the business got sued before you were a partner, then you can't be liable for anything that happened before you were a partner. And typically, if one of the partners acts in a criminal way, then it's on them individually, meaning not all of the partners will go to jail because one of them acted in a criminal way. So there's a little bit of a relief anyway. So finally, what happens at the end of a partnership? So recognize that if any partner in a partnership decides to bail out of the partnership, that causes something called dissolution. And so what happens is the dissolution terminates the authority of that partner who wants to pull out. And then the remaining partners get to decide, are we going to continue the business as a new partnership, or are we going to terminate the business altogether? If they continue, then all their old creditors remain. The former partner remains liable for any obligations that came up while they were a partner, but they're not liable for anything in the new partnership as it goes forward. If the partners decide to terminate the firm, then they do what's called winding up, which means they finish up all the business at hand. Any contracts that you're still working on with other people, you finish those up. Then you pay off creditors, meaning people you owe money to, and then you split up anything that's left over, right? So you receive any revenue that was coming in, you pay off all your debts, and then you split up whatever's left over between the three partners. And that's it. So again, I'm not sure why it took 2 chapters for the textbook authors to cover all of this, when I think we're able to cover it pretty well in under 20 minutes. But it's important because many of you will end up being part of partnerships at some point in the future. So hopefully it's valuable information to you as you go out into your business lives.